So, hello students. So this is a nice moment again. We come in for another session of financial reporting. That is under the intermediate level, as they say, under the current syllabus. So we are going to do conversion of a partnership to a limited company. Remember that previous syllabus, it was concerning dissolution of a partnership, amalgamation of two partnership funds, then conversion of a partnership to a limited company. So dissolution of a partnership and amalgamation of two partnership funds, they were dropped from the syllabus. There's nowhere you will read them, even if it's in advanced level. So you will only be taught conversion of a partnership to a limited company. So when you convert a partnership to a company, remember that a partnership operates under Cap 29, but now when you convert it to a company, now it will start to operate under Cap 486 as a limited entity. So during conversion of a partnership to a limited company, we have various books to be closed under the partnership, starting from the realization account, partners, capital account, we have to prepare that one, revaluation account, we have the appropriation account, and we have the realization account. So those are some of the, other than realization, we have revaluation account, then partners capital account, then appropriation account. So those are some of the books to prepare when you are converting a partnership to a limited company. So in sense, I can say that, in simple, I can say that they are closed. So then once you close them and you open now the financial statement of the company. So for the company, you only open the financial statement. So to interpret more about this conversion, you need to know that when was conversion taking place? Was it taking place at the end of the year or was it taking place during the year? We have already covered a question of 2014, which is under record again, under YouTube. It's already there. If you could like to one check, that question of 2014 is recorded. So it might be on the public platform or it might be on the private platform. So if it's not on the public platform, you check on the private platform. So I think for the guys who are attending this class, you have access to both. The videos which are under the private platform, that I mean the one which are in the one who are attending this live class, they are always they have that access to the private videos in my private account and the one which are on the public platform. So for 2014, it's there. So that one, the conversion was occurring during the year. So I want to do another one for 2018, that is May 2018. Now, this question now, conversion occurred at the end of the year. So that is the two ways they can twist. And at the same time, another thing they can twist a question is all about, did they provide net profit, or you have to do an income statement to determine. For now, right now, a question of 2014, that one you were supposed to do a statement of comprehensive income to determine that net profit. So, but if you are given net profit, that is now the point whereby you have to start from appropriation account. And this appropriation account is whereby the partners are supposed to share the profit, that net profit, before conversion. Then if you are starting from appropriation account, you go down, you do current account, you do realization account, you do the capital account, then you finish with the statement of financial position of the company. So to differentiate the two, for the student, maybe you could get access to these videos and they are not part of this session, the right one. Remember to go and check the question of 2014 other than the one for 2018. So let us do that one for 2018, guys, so that you can understand what is different when they have provided net profit and when conversion has occurred at the end of the year. Unlike the one which we have done, whereby net profit was not there and the conversion was during the year. So to answer that concept, this is a question of 2018 May, which says that Chanda, Pete, Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:1, respectively, after allowing for a 10% per annum interest on fixed capital balances and a commission entitled to a partner. The trial balance extracted from the financial records of the partnership as at 30 September 2017 is set out below. You don't have to read the trial balance. At your level, you know that what is contained in the trial balance is assets, liabilities, equity, income, so all the items that is from assets, liabilities, expenses, incomes, and equity. Both of them are there. All of them are there. Additional information, Kidore was the only active partner and was entitled to a commission of 15% based on the annual sales revenue, which averaged shillings 20 million. The partners resolved to convert the business into that of a company to be named Chambeki Limited with effect from 1st October 2017 under the following terms. Investment comprised equity investment, which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to the profit share. Investment had a market value of 50 million on 30th September 2017. After assets and liabilities were transferred to the new company at the following agreed values: land and building, motor vehicle, office equipment, furniture and fittings. Inventories at book value raised 5%. Account receivable at book value raised 2.5%. Current liabilities at book value. Goodwill was considered valueless and therefore was written off. Purchase consideration on business purchase was agreed at shillings 250 million. The partners were to become shareholders. The company issued ordinary shares at par value of shillings 10 each to the partners to satisfy the balances due to them as at 30 September 2017. Upon incorporation, the new company issued a new debenture at par, carrying interest at 14% per annum. The cash proceeds from the issue amounting to shillings 50 million were used to purchase additional stock of raw materials worth shillings 15 million. Accrued expenses were settled in full. So you are required to do realization account, partners capital account, Jambeki Limited account to close off the partnership books. Opening statement of financial position of Jambeki Limited. So on this case, my good students, on this case, never just panic. Never panic, because most of the students, I find that when you start a paper, let's say the first 1 hour, when you enter an exam room, most of the students, you panic. Panicking, it makes you forget everything you have just studied for the whole semester. So towards the end, 1 hour, towards the end of the exam takes 3 hours. Towards the end, that is 1 hour remaining. That is when you find that students have a lot of information to write. Mbona ukuwa na hiyo information ukianza questions? If you could have entered an exam room with the same morale which you finish with, that paper you can even do it 2 hours. When I was a student, most of my papers, I was doing them 2 hours, 2 hours and a half. Like now, Kamban Law, I did it for 2 hours. FR, 2 hours. So you can do it for 2 hours, you are done. If you enter an exam room, first you have prepared early enough. You have been doing your preparations. You have been carrying out your preparations for 3 months. Why go and panic in the 3 hours in an exam scenario? You know what is supposed to be brought in an exam is what you have done. There's nothing which will be outside that. At least you can't miss even 3 questions you have been doing here and there. So, like now, this question of partnership conversion, you follow the concepts I have been using. Never go direct and draw realization. Like now, here they need realization. They need partners capital account. Never go direct and start drawing these accounts. Follow the procedure I've been talking about. So the first thing you go and check, was there net profit? Next, when was a conversion taking place? So which means that you need to draw a line which shows you when the financial year ends, so that to determine. So our financial year ends when? Our financial year ends, as per the trial balance was of 30th September 2017. Was that of 30th September 2017. So was of 30th September 2017. So which means that our financial year starts on 1st October 2016. Then when was this conversion taking place? When was conversion taking place? Was it during the year or at the end of the year? So you go and check. So Chanda Pete, so it was under additional information. You don't have to read everything. So it was under additional information number 2. Partner resolved to convert the business into the company to be named Jambeki Limited with effect from 1st October 2017. 1st October, which means that it's at the end of the year. So it's just 1 day after September. 1 day after September, which means that it's at the end of the year. That is fine. So which means that in the next financial year, it will not be a partnership again, but it will be a company. Under the next financial year, it will never be a partnership again, but it will be a company. Then you check on your trial balance. Check on the trial balance. Are you provided net profit? If yes, this question is simple. If yes, the question is very simple. It's there. Net profit for the year. Net profit for the year. So since you are given a net profit for the year, it means that nobody will tell you to determine net profit again. Which means that nobody will tell you to determine income statement. That is why in the additional information, not in the additional information. That is why under the requirement, you were never told to do the income statement, because already they have provided the net profit. They will only tell you to do the statement of comprehensive income if you are not given the net profit. If you are not provided the net profit. So if you are given the net profit, you start from appropriation account, because this was net profit of the partnership before conversion. 30th September 2017, that is when the year is ending. Conversion occurred 1st October. That's 1 day after this, after 30th September 2017. So what we do, we start from appropriation account now. That profit will be shared. That profit will be shared. That profit will be shared among the partners before conversion. So we start from the net profit, So the net profit was 91 something, 91,000, if I'm not wrong, but that one is in the question. So the net profit, 91,000. So this profit is supposed to be shared among the partners. This profit is supposed to be shared among the partners. But now, before we share, we consider what was around by those partners under the partnership. They said Chanda Pete Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:1. After allowing for 10% per annum interest on fixed capital and commission. You can see here. So what was around there is interest on fixed capital and a commission. Interest on capital and commission. Interest on capital. So that one you raise. So the only item I said we can add back is interest on drawing if it was around. So we have interest on capital And remember that we have Chanda, Pete, Kidore. I will be using CPK, Chanda, Pete, Kidore. Then we have commission. We have commission. So this one is 10%. This one is 10%, and the last one is 10%. 10%, 10%, 10% of the capital, of the capital, of the capital. So the capital you can see is 58,500. We have 37,000, and we have 31,500. So for the commission, this one was dictated by additional information number 1. Kidore was the only active partner and was entitled to a commission of 15% on annual sales, which averaged 20 million. So 15% of 20 million, which means that 15% of 20,000. Our question is in terms of thousands. This one is in terms of thousands. So this one would be 5850. This one would be 3700. This is 3150. Then 0.15 times 20,000. This one would be 3,000. So this one we can put it at the end here. We deduct. Then 5150 plus 3,700 plus 3,150. That is 12,700.
12,700.
So you get a profit available for sharing. So the profit available for sharing, that is 91,000 minus 12,700 minus 3,000. So that is 75,300. Then we share that profit. We say profit share. We share it. So the profit share, it's among Chanda, Pete, Kidore. You share in the ratio of 2:2:1, 2/5, 2/5, 1/5. You were told they were sharing profit or loss in this ratio. If they could have not mentioned the ratio, they are supposed to share the profit or loss. You use an equal share. That is according to the CAP 29. If there's no ratio which is given, they share equally. They share it equally. That is according to CAP 29. So we have 3120. So we have a 3120. We have 3120. Then 75,300 minus answer. So 15,060. So that is 15,060. So that one give me 75,300. So the 75,300. So this one we have shared here, we have nil. Then after that, we do current account. The information from the appropriation account is supposed to be shared in the current. It's supposed to be taken to the current account. So we have Chanda, Pete, Kidore. Chanda, Pete, Kidore. So this person was a bit used very good names, Chanda, Pete, Kidore. So the balance brought down for the current account, you can see them here under the trial balance, 2,800 So the account I'm preparing there is current account. So we have 2,800. 2,800. We have 18,200. We have 13,300. Eh? We have 13,300. So that is the balance brought down to start with. Then after the balance brought down, now we close the balances from the appropriation account to this account, interest on capital. So the 5850, we have 3,700, and we have 3,150. There was commission, and the commission, remember they said it was to Gidor, eh? He was the only active partner. And they received that commission based on the sales revenue, which averaged 20 million. That is what they said in additional information number 1. You can check in that question. Then after that, we have a profit. We have a profit 3,120, 3,120, and 15,060. After that, I said under the debit side, we recorded drawings. And if there was interest on drawing, of which if there was interest on drawing, which was allowed, we could have recorded under appropriation account. But there was no interest on drawing, which was allowed. Eh? But there was drawings. There was drawings. Drawings is there under the trial balance, 78. We have 65. And we have 39. And we have 39. That is okay. So that the balancing figure goes to the capital account. The balancing figure to capital account. So give me the answers to this account. So after balancing this figure, we have 48. After balancing this account, we have 48,970, 45,520, and 30,610. So after that, I have to prepare now a realization account, because now I don't have to prepare a valuation account. You know that the conversion occurred at the end of the year. So realization account, to record how the assets and liabilities were taken over. To record how the assets and liabilities were taken over. So when we are closing an asset account, remember that assets are debited first before we convert. So before we close, not convert, before we close an asset account, obvious assets are debited. So in order to close your asset account, what you do, you credit asset account to debit realization. So under realization, all assets you debit, the one which are taken over, but now you debit with the figures they were stated in the partnership, because we are closing them as the way they were recorded in the partnership. Then after that, liabilities. When you close a liability account, you debit the relevant liability, you credit realization. So in short, what we are supposed to do is all about under realization, assets you debit. The one which were taken over. The one which were taken over, you debit, then you credit liabilities. Again, the one which were taken over, but now you do that with the figures as per the partnership. The figures in the partnership. You do that with the figures in the partnership. So right now, let's check. You are told that additional information number 2. The partners resolved to convert the business into that of a company to be named Jambeke Limited with effect from 1st October 2017 under the following terms. Investment comprised equity investment, which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to profit share. The investment had a market value of 50 million. So let's close off investment. So the investment now, you don't have, you will not record the way the partners took them, but you record the way they were stated in the partnership. So the figures in the partnership for investment was 44,800. Remember that the investment is an asset. To close that, under the investment account, you credit. Realization, you debit. So in short, assets, you debit. Under this, so here, investment was 44,800. So in short, you debit the assets, the one which were taken over with the figures they were stated with under the partnership. So that was the first one. So I can just write them, then we just record. The second one is run and building. That is, other assets and liabilities were transferred to the new company at the following agreed values. Run and building. And remember that you have to record them at net book value. So if there is an aspect of depreciation, you deduct. So run and building, under the partnership, it was 123,500. You can see up there. You minus depreciation of the building, 2150. 2150. It was taken over, but I have said you record with what? The way they were stated in the partnership. Remember, we are closing those accounts. The investment account, run and building, the one which was taken over. Now we are closing them under the partnership before we open the company. So 2150. I think the position was 2150, yes. So you get here, you minus, you get 103,350. We do the same for all the assets, the one which were taken over. So the next one being, after run and building, we have motor vehicle. So motor vehicle with their book value in the partnership. So motor vehicle is 8,600 minus depreciation of motor vehicle, 54,600. You minus 54,600. So take 8,600 minus 54,600. I'm getting 26,000. 26,000. We do the next one. So the next one is all about office equipment. Office equipment. Office equipment, up there, it's under the partnership, 7,200. You minus depreciation of 24,400. Of 24,400. So 7,200 minus 24,400. We get 45,800. I'm getting 45,800. I'm getting 45,800. I think you are following. And the next thing is concerning. The next thing is concerning fixtures, and that is a furniture and fixtures. Furniture and the fixtures. So the furnitures and fixtures. So furnitures and fixtures up there under the partnership was 52,000 minus depreciation of 18,500. 18,500. So 52,000 minus 18,500. I'm getting 33,500. I'm getting the 33,500. That is what I'm getting there. So let me make the whiteboard a bit accessible to you. So that is fine. I think we can do it from here so that we extend the account. So the next thing, after we are done with furnitures and fittings, we have the other assets. Other assets like what? Like now, after furnitures and fixtures, we have inventory. So never be confused because you will find another student telling me that raise 5%. No, for now we are just talking about inventory. The way they were stated in the partnership is the way they were stated in the partnership. You can see start 1, 200. Start 1, 200. That is what you record. The start 1, 200. That is what you record there. That is what I've recorded. Then the next thing is all about, so now I can record all of them, then I display. So the another thing there is account receivable. Receivable, the way they were in partnership, receivable. So receivable in partnership, remember that we are closing those accounts in the partnership. So 25, so that is why I'm recording the figures in the partnership because we are closing them. So 25, 400. Is there anything here? Current liabilities at book values. So for now, we consider the one which are up there, current liabilities. So those ones you credit because to close a liability, it was credited, yes, before we close, it was credited, a liability is credited. So to close it, you debit the relevant liability account, you credit realization. You credit realization. So we have these payable, bank overdraft, and accrued expenses. We have payable, bank overdraft,
accrued expenses.
So payable is 62,400. We have 17, 550, and we have 4,000. So those ones I have credited. Then what you include here is the investment now and the purchase consideration. Remember, when I will be preparing my capital account, the investment, this investment will be debited because the investment is the one which partners took to reduce their claims. So under the capital account, you debit, you credit realization. Then when I will be preparing the Chambeki Limited account, I will debit purchase consideration. Under realization, you credit. So the investment you record at market value, it was 50,000 according to note 2. You can read there. Purchase consideration was to 50,000. Purchase consideration was to 50,000. So in an exam scenario, even if you miss investment and you miss to record purchase consideration, that account you have scored everything. For realization, you could have scored everything. So since you know that assets you debit, liabilities you credit, but with which figures? The one which are in the partnership, of which you consider the assets which were taken over. So the one I've talked about investment is this one. Investment had a market value of 50 million. Remember that it was taken over by the partners to reduce their claims under the partnership. Then the proceeds, the purchase consideration, not proceeds, the purchase consideration is down here. The purchase consideration on the business purchaser was agreed at 250. Goodwill, I have not recorded. It was considered valueless. That is why I have not recorded there. But it will be recorded under the partner's capital account, because we said if it's positive goodwill, we credit under the partner's capital account. If it's negative, we debit. Being valueless, it's like it's a negative goodwill, so we debit under the partner's capital account. Purchase consideration is the 250 there, you can see it. So after that, you do a balancing figure. After getting your balancing figure, which obviously will be on the debit side, because I can see here now these figures are a bit big. So after getting this, you share here this balancing figure to capital account. To capital account, you share with the ratio of 2:1 to Chanda, Pete, and Kidore. So in the ratio of 2:1. So this one will be 2/5, 2/5, 1/5. So you share it there. So the totals, so look for the total in the credit side, you minus with the total of debit side, then the balancing figure, you share it with the profit and loss sharing ratio. So after getting the balancing figure, after sharing, we are getting what will go to Chanda is 29,560. 29,560 for Pete and 14,780 for Kidore. That is the balancing figure which is shared in the ratio of 2:1, the profit and loss sharing ratio. And that balancing figure will be closed to the capital account. So after we are done with the realization account, now we can talk about the capital account. We can talk here what is supposed to be done under the capital account. So we have Chanda, Pete, Kidore. So Chanda, Pete, Kidore, Chanda, Pete, Kidore. So the balance brought down for the capital account. So the balance brought down for the capital account was, so you check from your question. So for the capital account, I can see we have 58,500. We have 37,000. We have 37,000 and we have 31,500. So after that, we have to talk about the balances. Now we have to close the balances which are supposed to be closed from these accounts. The balances which are supposed to be closed from the capital account, not from the capital account, but from the current account and the realization account. So from the current account, we have current account. So from the current account, we have 48. There was 48,970. There was 45,520, and there was 30,610. So I think now the camera is a bit okay. So there's somewhere which I never touched. I think, anyway, even from the start, it was fine. But I think now it's a bit better. Then there is that realization. So the realization is 29,560, 29,560, and 14,780. The balancing figures. Then after that, was there goodwill? Goodwill was valued as, so it was not here. You record it under the debit side. So the goodwill was, so the goodwill. So the goodwill under it is 26,000. So you share it in the ratio of 2:1. The profit and loss sharing ratio. The 26,000, share it in the ratio is 2:1. 2:1. So 26,000 times 2/5. We have 10,400. I'm debiting because it was valueless, considered to be negative. Then the last thing is all about 1/5, so 52. Then there was this investment, which we said we debit to reduce their claim, to reduce the partner's claim, because their partner's claim is on the credit side. And remember that this account is partner's capital account. The partner's capital account. So investment was 50,000. Its market value was 50,000. So you share it in the ratio of 2:1. 2:2:1. So 2/5 times 20,000. So 2:1 times 50,000, not 20,000. So 50,000. So you get 20,000. You get 20,000 here, and the last one is 10. You get 10,000. So that, give me the balancing figure now, which will be going to the company as capital of the shareholders now. The same partners will be shareholders. So now the capital, so these are about to company. So the share capital now. The share capital to the company. So after balancing this account, the capital we are getting to the company for Chanda is 106,630. For Pete is 81,680. And for Kidore is 61,690. So what are we supposed to do next? Or now you can even go and check what was required for you to do. After reaching the point of partner's capital account, we can go and check. The examiner required us to do realization account. We have done it. So remember that I never followed their requirements. I just did my work the way conversion is supposed to be done. But doing that, realization has been done. Partner's capital account has been worked out. So the only thing which is remaining under this is the Jabeki Limited account, then we get 10 marks. So Jabeki Limited account, remember, is now the company which was paying the partners. And obviously the partners are paid an amount which is equivalent to their capital contribution. Amount equivalent to their capital. So Jambeki, he was paying them. We said that this purchase consideration, which was credited under realization, we debit here. Purchase consideration, 250. This is the amount which was paid by Jambeki when he was acquiring this partner. So this amount is supposed to be equivalent to this capital. So partner's capital. So Chanda was given in the company, he will be given 106,630 as share capital. He will be given, Peter will be given 81,680, and Kidore will be given 61,690. So this amount is supposed to be the same as 250, which Jambeki paid. So if you add the three, you are supposed to get to 50,000. So I think you can see it's 250,000. And that is how you know that you are correct. What you are doing is not gambling, but we are doing the correct work. We are doing the re-cheat work. So after that, we can now do the last part of the question, statement of financial position, the opening one. Because they call it opening, because now, remember that in the next financial year now, it will be a company. So with a new statement, we have closed the partnership so far. So the last thing we have to do here now is the statement of financial position for Jambeki. So Jambeki Limited. So that is Jambeki Limited. So we have the opening statement of financial position. So as at 1st October 2017, at the start of the year. So it's a copy-paste work. I mean copy-paste because for the assets, you record the way they were taken over. Now you record with the figures given down here. Other assets and liabilities were transferred to the new company. I'm not recording investment. Investment was taken over by the individual partners, as told there. So other assets were transferred to the new company as follows: land and building. Land and building 115. So I would just record, then you will see what I record later. Land and building, you can see that is the way I'm recording there. So I just record them. I can display. Then motor vehicle, 25,500. Office equipment, 43,500. Furniture, you can see it was a copy paste. Furniture and fixtures, 29,550. So after that, before we record inventories and the others, because those are current assets, you include goodwill here. You check the new goodwill now. We need to do a working on that. The goodwill of the company. Then this is non-current assets. So current assets, so I will just say CA, current assets. So this inventory. So inventories, what did they say? Inventories, they said that At book value, raise 5%, which means that it will be stated at 95%. 95. So because they say raise 5%. Now the raise 5% will be applicable here, not when we were preparing a realization account, but now when you are preparing the statement of financial position of the company. So inventories is 31,200. Then we have receivables. They say dress what? Receivables. Under inventories, there is something I will include there. That is why I have not recorded the figure. So receivables, there is a rest 2.5. So it would be at 97.5. 97.5% terms. Receivables up here. The receivables is 25,400. Then we have after receivables, so inventories and receivables, that is fine. So if you go to your additional information number 3, they said that upon incorporation, the new company issued new debentures at par, carrying interest at 14% per annum. The cash proceeds from the issue amounting to 50 million were used to purchase additional stock of raw materials worth 15 million. Accrued expenses were settled in full. So there was a debenture which was issued, which was carrying an interest of 14% per annum. The cash proceeds from the issue of the debenture is 50 million. They used that debenture to purchase additional stock of 15 million. So which means that my stock have to increase. Inventory will be increased by 15. Then I need to get cash because there's proceeds which they got. So that means that I need to open a small account here called cash account as a working. Was there balance brought down? There was none, but there was a bank overdraft. A bank overdraft is a negative account in your. So let's say like now, if you have an authority whereby you can withdraw money from your account and it goes to a negative. And a good example is a freezer. Is there anybody who doesn't freezer here? Is there anybody who has never done freezer? So freezer, you remember that you send money you don't have. So that anything coming in, it's deducted. That is a good example of an overdraft. So there was an overdraft of, there was a good overdraft of, there's this 4,000 or 17,550. 17,550. So when they issued a debenture, remember that they received the issue of debenture, they received 50 million, which is 50,000. So which offsetted the bank overdraft. Then they purchased raw materials. And they paid some accrued expenses as told in the additional information number 3. As told in the additional information number 3. Obvious, for an overdraft, they have to pay for any money which came in. Then additional stock of raw material, 15 million. So we credit under that cash account, and accrued expense was settled. Accrued expense under this is 4,000. So that you check the balance which is remaining. You check the balance which is remaining. That is what we record as cash balance. So balance carried down here. So 17,550 plus 15,000 plus 4,000. Then 50,000 minus the answer. I have multiplied instead of minus. So that is 13,450. 13,450. This is the balance carried down. So 13,450. So someone who has the total for inventory, tell us the total there is. The one who has done the computation for inventory. Are you getting this amount? 44,640. That is fine. Then 97 means 25,400 times 97.5%. So that is 24,765. So this one was cash balance. So the balance carried out from there. So total assets. So equities and liabilities. So for equities and liabilities, remember that you record the ordinary share capital. So the balancing figure from the capital account. So from the partners capital account, there was that for Chan, it was 106, 630 plus 81, 680 for Pete, and the 61, 690. So this one we already added. It was 250,000. It was 250,000. Can we talk about non-current liabilities? So non-current liabilities, just the 14% debenture, the one which they issued, the debenture, which they raised 50,000, which they raised 50,000, the debenture which they raised 50,000, the debenture which they raised 50,000. Then for the current liabilities, remember that bank overdraft was already paid. This one is paid. Accruals has already been paid. So the only thing which was remaining, which was never paid, is the creditors, payables, the creditors balances. So that is what we record. So the creditors balances is payables 62,400. 62,400. So that is total equity and liabilities. So here we have goodwill. We have to determine to be able, goodwill would be like balancing figure. Because what I will do here, you know that goodwill is all about purchase consideration. The purchase consideration, you minus the net assets. So this net asset is just the assets you minus liabilities. Assets you minus the liabilities. The assets minus liabilities. So the purchase consideration was 250,000. For the assets, you add the assets you have here. This one. So 115 plus 25,500 plus 43,500 plus 29,550 plus 44,640 plus 24,765 plus 13,450. So 296,45. For liabilities, is this 50,000 long term and short term? So this one is around one. So which is 11? That is 11 to 400. Because we have 50,000 plus 62,400. Yes. So you will take 250,000 minus, so 296,45 minus 112,400. So this is 184,005. So 250,000 minus the answer. So this one will be 65,995. That is what you record here. So if you add the assets, because already I know the other assets were 296,45, the total plus 65,995, the goodwill now. This one will be 362,400 for the assets, for the total assets. Then for the liabilities, I will just take my 112,400, plus 250,000, the equity. You can see it's coming 362,400. And that one marks the end of that question, and that is how you are supposed to do it. Now you can be able to differentiate when there is this aspect of conversion during the year and conversion at the end of the year, and at the same time, when you are given net profit and when you are not given net profit, where do you start from? You can have a nice time. It was a good session, I can say. So that when we meet next time in our next sessions, now I will be tackling the remaining major topic, which is branch accounting. I think that is the only remaining bigger topic. The others is just small, so that you can say that you have at least covered 80% of your syllabus, which will be tested in the coming exam. So this was a good session for today's class. So we have done partnership. So we have done that partnership. So partnership, remember that we have covered that area whereby the partnership has been disposed at the end of the year. So I could request that you go to the YouTube channel and check the other question whereby the disposal took place during the year. So, other than partnership, remember that under financial reporting, there's other topics. Right now, the major topic is group accounting. We have a group accounting. We have a cash flow, and we have the partnership I mentioned about it. We have published accounts. We have the published accounts. So the published account. So those are some of the main areas. So those are some of the main areas which you need to understand more when we are talking about financial reporting, section 3. So besides topics like farming, topics like we have professional funds, we have purchase, we have cooperatives. So, but these are the main topics. So from partnership, group accounting, cash flow, published accounts, and we have what we call branch accounts. So the branch accounts. So from next week, I mentioned that there is a revision which is starting. That is from Monday onwards until you do exams. So you are highly welcome to join the revision classes, and at the same time, other than the revision classes, you can buy my videos, the one which are on the private account of YouTube. You can buy at a very small cost. So if you would like to get those videos and at the same time, if you would like to join the revision classes, you can be able to reach me through the 07, so that is 07 28 716 546. Without forgetting again, these are the main topics under financial reporting and analysis. Partnership, just conversion. For now, it's only conversion of a partnership. Group accounting, understand it. We have cash flow and we have published accounts. Then finally, we have the branch. The branch account. So that was our 5 class for today. I think we can call it a session. And at the same time, you are highly welcome for the revision I'm talking about. So have a good time, continue with your revision, share my videos with your friends so that they can be assisted by this free content we are giving out. So have a nice week ahead and a nice time as you prepare for your December exams. So the guys from Rwanda, the guys from Nigeria, the students from South Africa, nice time. Have the best time in your revision.